morning, everyone. Are you able to hear me? Yeah, are you able to hear me out? Hello?
Good afternoon, sir.
Yeah, can you hear me?
Yes, sir.
Fine. So today is 2nd of November. I had given you an assignment to be submitted, right? How many of you are ready with your assignments? Please raise your finger, those who are ready with your assignments, quickly. Yeah, how many of you are ready with your assignments? Okay. Have you mailed it to me?
Yes, sir.
Okay.
Yes, sir. I have done.
What about others? There are still a lot of people who have not completed their assignments. Okay, fine. So we'll start with the place where we had stopped. I think in my last class, in my last class, we discussed about the risk and return concept. I told you how do we solve the problems on Excel using a concept called as data analysis. And based on that, I also told you how to arrive at the solution of computing beta and the intercept, which is nothing but alpha. Can you recall all those things that I have discussed? Can you recall? Yes, Naren, any doubts? I think you have raised your hand. Yeah, Naren, any doubts? You have raised your hand. That's the reason I have stopped. Okay, I think it's not there. So, uh, I discussed this. If you have any doubts in this, please let me know. I will take one more class of this because after that particular class, we had a long gap. I think you had your exams, then we had holidays, and then again you had your training and placement, session that took place. We had a holiday. So I think a week's time was lost in whatever I was been informed to you as far as risk and return analysis is concerned. Okay, are you comfortable with that particular concept, or you need an explanation? The reason I'm asking you this, the next assignment would be a group assignment. I repeat, the next assignment would be a group assignment, and that's the reason I am raising this question again. If you have no doubts, then I will create a group, and based on that particular group, you will have to do your second assignment. Yes. So based on your no the present the group formation, a second assignment would be given to you, and you will have to complete that particular second assignment also. Okay. Now the second assignment is going to be a combination of unit number 3 and unit number no the next unit, that is fundamental and technical analysis. So this is a combination of both the units. I will tell you the date of submission. If I'm not wrong, the date of submission will be somewhere around 20th of November. 20th to 24th of November would be the date of submission of the next assignment. Okay, this is as far as investment management is concerned. Today afternoon, today by late evening, I will give you the first assignment of tax management, direct taxation. So the date of submission for that particular assignment would be on 10th of November. Okay, and once we are done with the first tax assignment, I will give you the second one. Clear? I don't want to burden you with two parallel assignments. That's the reason I'm giving you a time gap. Okay, fine. So we move on to the next part of how do we assign a value, or how do we put a price tag to a bond, and how do we put a price tag to an equity? So that is what we understand by the concept of what do you mean by bond valuation and equity valuation. Clear? All of you are with me? We are trying to understand how do we arrive at the value of a particular security, whether it could be bond or whether it could be a equity, whatever it is. How do we arrive at a value of it is what we are going to understand. So preliminary, we will start our discussion only with the bond valuation, and then we will further go on to equity valuation. Now, when it comes to bond valuation, it is completely different from the way we value an equity. And that is where, in this particular session or in this particular part of bond valuation, you have something called as you have some theories that you have to study. You have to study some theorems. I think in your 8, 9, 10 standard mathematics, especially in geometry, you have studied some theorems, right? Whenever you studied circles or whenever you studied triangles, you studied some theorems, right? On similar basis, we have 5 theorems as far as bond valuation is concerned, and then we also have 3 theories as far as bond valuation is concerned. So this is what is going to be covered up as far as bond valuation is concerned. From your exam point of view, we can expect around 15 to 20 marks of questions arising only from bond valuation. So that is the importance of this particular concept of bond valuations. Clear? And later on, of course, we'll go to equity valuation at a later stage. But first, we'll try to understand bond valuation. Yeah. Any doubts in this? So far, whatever is been discussed. If you have any doubts, please raise your hand quickly so that we can quickly resolve them. Fine. So we move on to the next part. Now, when we come to the concept of bond valuation, we need to know the basic meaning of the word bond. Okay. So what do you mean by a bond? In plain and simple words, you can go through this particular definition. It is there on your slide. But what I would like to tell you is a bond is nothing but it is a contract wherein the borrower, okay, say for example, now let us take a simple example. I am a company, I am a person who requires money. So if I want money, I can raise money through equity, I can raise money through taking a bank loan, I can raise money through my savings, I can raise money through whatever means as possible. One of the ways to raise money is definitely a concept called as bond issue or debenture issue. Now what happens is in this particular concept, instead of taking a loan from a bank, I take loan from the people of India. So whenever a government, a public sector undertaking, a state government, or a local municipal government requires money, they generally issue a security, and the name of that particular security is a bond. Why is it called a bond? Because it is assured that you will get a certain fixed amount of money at the end of the maturity period. That is the reason it is a bond. So in other words, bond is nothing but a contract, right? So it requires a borrower to pay a fixed rate of interest to the lender. Now, in plain and simple words, let us assume that I am the state government of this particular state and you are the residents of this particular state. I decide to come up with a concept. I decide that I want to increase the rural connectivity of Karnataka. If I have to increase the rural connectivity of Karnataka, I need to build roads. So in order to build roads, it's very simple. I need money. Without money, nothing is possible. So in order to generate money, there are 2 ways. Either I can use the money that I receive in the form of taxes, or I have to generate money through my other source. So I decide to generate money through some alternative source. And what is that I offer to all the citizens of Karnataka? I tell you that I want to develop rural connectivity, and for that reason, I require money. If you are interested to give me money, the minimum amount that you have to give me is 1,000 rupees and in multiples of 1,000 rupees, right? And once you give this 1,000 rupees, take it assured from me that I am going to return this money back to you after 10 years at a rate of interest of 15%. 15%. That means, come what may, as a state government or as a government of this particular state, I am taking an underwriting on myself that come what may, if I borrow money from all of you who are attending this particular class, if I borrow money from you in multiples of thousands, I will assure you 15% rate of interest. Come what may, that is a sure rate of interest that I can give you. Okay. So that is what it says. Here, borrower is the state government That is, I am the borrower here. Okay. And lender, you all people who are attending this particular class, you are the lenders for this particular state government. Why? Because each one of you is giving some money. Probably Narayan is giving 10,000. No, somebody else is giving 15,000. Somebody else is giving only 5,000. All of you are lending your money to me. So you are lenders and I am the borrower. And for simple reason, because I am borrowing money from you, I have to pay you interest. And I have to pay you interest in a fixed time bound frame. That means when I decide to 10 years means in 10 years only I have to pay this particular interest, with an undertaking that at the end of 10th year I am going to return this entire money back to you. Is it clear for you? Any doubts in understanding? Please tell me this concept that I have explained to you so far, called as the concept of bond. Any doubts in this? If there are no doubts, please say that there are no doubts so that I can proceed.
No, sir.
Okay, fine. So now we know what is the meaning of the word bond. Okay, it's a contract, okay, between the buyer and the borrower and the lender for a fixed sum of money for a fixed period of time. Fine. So this is the basic concept of bond is what we have to understand. Next, we are trying to understand what are the features or what does the bond comprise of. A bond is nothing but it's a legal contract. Okay, it's like a legal contract. Whenever there is a legal contract, it should have some face value on printed on that particular paper. Okay. Now, I will tell you what is a bond basically. Uh, I hope all of you have gone to some or the other place where you have taken a stamp paper in whichever state you belong to. You have taken stamp papers, maybe for rent agreement, maybe to make an affidavit. For some or the other reason, you have purchased a stamp paper. Now, when you purchase a stamp paper, the value of that particular paper is printed on that particular paper sheet. Do you agree with that? Do you agree that when you go and buy a stamp paper of 50 rupees, 100 rupees, 500 rupees, whatever it is, okay, when you pay that money to that particular society or to that particular institution, he prepares a paper in your name. That means your name comes first as first party, and the uh, name of the second party also comes, and they tell you what is the value of this particular paper. The value of this particular paper is 100 rupees or 200 rupees. Something is printed on that. Do you agree with me?
Yes, sir.
Now, on similar basis, any bond that you purchase will have the first party, that is the lender, okay, the second party as the borrower, and how much money are you giving or how much is the face value of this particular bond is been printed here, printed on that particular sheet of paper. So by default, the face value or the par value of a bond is always 1000 rupees. Likewise, the face value of a share is always 10 rupees. Likewise, the face value of bond is always 1000 rupees. So come what may, 1000 rupees will be printed. Now suppose if Narayan purchases, okay, Narayan decides to give me 5000 rupees, okay. So 1000 rupees will be printed on the paper. Only what they will do is into 5 is what they will write down. So that becomes 5000 rupees. So the face value of the bond never changes. What changes is the quantity changes, and that is what is been, that is a variable component that keeps on changing. So always a bond should have a face value or a par value. The bond should keep a constantly mention what is the rate of interest. Please understand, whenever a bond pays rate of interest, it is called as a coupon rate, right? In the example that I told you above, I am the state government of Karnataka. I decide to borrow money. I borrow money at the rate of interest of 15%. So 15% is nothing but coupon rate. Okay, 15% is nothing but coupon rate. Are you able to understand? So whenever a bond pays interest, it is mentioned by the word called as coupon. Whenever a debenture pays interest, it is mentioned as interest. But whenever a bonds pay interest, it is always referred as coupon rate. Okay, and the money that is paid is called coupon payment. What is, Narayan, what is 15% of 1000 rupees? 15%
One
of
one
1000
fifty, sir.
rupees, what is it?
150.
150.
Yes, sir.
So 150 is the coupon payment. So coupon payment is 150 rupees. Coupon rate is 15%, 15. Please understand the difference. Coupon rate is 15%. Coupon payment is 150 rupees. So that is what has to be clearly mentioned on the bond value or bond paper. Next, it should also have it should also talk about a maturity value. When is the bond going to mature? That has to be mentioned. Suppose I say 10 years. So 10 years from today is what? 2029. Okay. The 2nd November 2029 is going to be 10 years from today. So maturity time, that is 10 years. Maturity date, that is 2nd November 2029, has to be mentioned here. Okay, so that is what we call as maturity value. Sorry, maturity value is the amount of money, and the maturity date, the rate I mentioned to you. Okay, then it should also have a concept called as call price. That means the maturity time of this particular bond is 10 years. In this 10 years, is there an option for the state government of Karnataka to recall the bond back from you? And if that is a provision, at what price will they recall the bond? That has to be mentioned. This is optional. Okay. And what is the required rate of return? That has to be clearly mentioned. That is for you to decide. But 1, 2, 3, and 4, the first 4 points have to be clearly mentioned on the bond. The fifth is your required rate of return. That is for your calculation. Clear? Any doubts in this?
No, sir.
Okay. Now, as I said, in the previous, I gave an explanation. The same explanation is here. So par value of the face value of the bond is always the amount, the money that has been mentioned on the face value of the bond. The face value of the bond is always 1,000 rupees. Please understand. Okay. The face value of a equity share is always 10 rupees. The face value of bond is always 1,000 rupees. Okay. Next, coupon rate is nothing but the rate of interest, and coupon payment is the money that is going to be paid. So one more thing, whenever a government issues bonds, the rate of interest is 15% in the example that we have decided. But interest is not going to be paid 15% annually. The rate of interest is going to be paid, or coupon payments are going to be done 2 times in a year. Okay. After every 6 months, the coupon payment is been done. So in the first 6 months, 7.5% of rate of interest will be credited to your account. In the next 6 months, the remaining 7.5% will be credited to your account. So total comes to 15%. So this is how interest is getting computed. This policy is mandatory for all bonds. So if the company is issuing bond, or if the state government is issuing bond, that means in a year, 2 times the rate of interest has to be paid, or 2 times coupon payments have to be made. Please understand, this is applicable only for government bonds, not applicable for companies, not applicable for debenture holders, not applicable for debenture payments. Only applicable for bonds. Clear? Fine. So the previous slide I did mention to you what is par value, coupon rate, coupon payment. Next, we talk about maturity date, on what day the the bond is going to mature, what is the original maturity, and what is the remaining maturity. All those things have to be clearly mentioned. And as I said, if the bond has an option to be called back anytime in these 10 years by its government of Karnataka, on what date tentatively the bond is going to be called back, and at what value the bond is going to be called back, that also has to be clearly mentioned. Clear? Any doubts in this? Yeah, any doubts here?
No, sir.
Okay. So this is what we discussed as far as the previous 2 slides are concerned. We talked about the ingredients, or what we call as what does the bond comprise of. So generally the question can come in an exam as define bond and what does bond comprise of. If this question is been asked, this is your answer with explanation for all the above things. So the explanation is available in this particular 2 slides. Next, we come to what are the different types of bonds. Again, from your exam point of view, a very important questions. Bonds are generally classified under 2 heads. First one we call them as the government bonds. Here, when we say government bonds, we are talking about the state government, we are talking about the central government, and we are talking about the municipal government, that is the local municipal corporations also. These are called as the government bonds. Okay. Now, apart from government bonds, there are some other bonds. We call them as corporate bonds. Okay. Now, corporate bonds, there is various classification that is available for us. We are going to discuss all these classifications one by one. Okay. From your exam point of view, if the question is raised as to define bonds and what are the different types of bonds, so you write down what is the meaning of bond, then tell them what are government bonds and what are corporate bonds. What we are going to do right now is we have done the classification on what is a bond. It can be a government bond and it can be a corporate bond. And now slowly we are going to understand what do you mean by straight bonds, what do you mean by floating bonds, and other types of bonds is what we are going to discuss right now. Is that okay? So we'll proceed with the first type of corporate bonds. We will call them as straight bonds. Okay. Now the straight bonds are also called as plain vanilla bonds, and they are very popular bonds. Okay. So it's a very simple bond. They pay a fixed rate of interest. They have a fixed maturity time. Okay. And there are no fancy things in this. The rate of interest does not change. The time, once it has been decided, does not change. It is very plain and simple and is generally followed. Most of the bonds that are issued today are straight bonds. We also call them as plain vanilla bonds. Okay. So what happens here? They pay a fixed rate of interest. They have a fixed time to mature, and at the end of maturity, your original principal amount is also given back to you. So that is what we call as the straight bonds. Okay. Next, we have a concept called as zero coupon bonds, or they are also called as deep discount bonds. Generally, Indian authors who have written books, they call this particular bond as zero coupon bond. Foreign authors, okay, they write the concept called as deep discount bonds. Technically speaking, both of them mean the same. There is no difference. Now, if you understand this, the word zero coupon means they do not carry rate of interest. Okay. Since they do not carry rate of interest, how do I attract you to take and come and buy this particular bond? I have to offer you a discount. In other words, a bond which is having a face value of 1,000 rupees, if I say you please come and give me 1,000 rupees for this particular bond, I will give you this particular bond. At the end of 5 years, I will return this 1,000 rupees back to you. Will you ever come to me? Because I'm taking 1,000 rupees and after 5 years I'm giving you 1,000 rupees. Will you ever come to me? You will never come to me because you're going to say, what is that I'm going to get in turn? I have given you 1,000 rupees, I'm getting back 1,000 rupees. What is that I'm going to earn? You're not going to earn anything. In this case, it is a zero coupon bond. But how do I make it look attractive to you, or how do I motivate you to come and buy this particular bond? The only option that I have is I have to offer a discount on this particular face value of the bond. I have to tell you that Rohin, this is a bond which is 1,000 rupees. I am issuing this particular bond for just 50 rupees, 50. Okay, I am issuing this particular bond only for 50 rupees. You pay 50 rupees now. After 20 years, you come and give this paper back to me. I will give you 1,000 rupees. That is what we call as deep discount. Why? The discount that I'm offering for a face value of 1,000 rupees, I'm just asking you to pay me 50 rupees. So by just paying 50 rupees, you tend to become an owner of a security which is worth 1,000 rupees. Rohin, will you come forward or will you not come forward?
So I will come.
The reason is
It's a good offer.
I'm offering a very deep discount. I'm offering a very deep discount on this particular bond. A bond which is worth 1,000 rupees, I'm offering only for 50 rupees. Definitely, you will come, purchase this particular paper for 50 rupees because you very well know you are going to get 1,000 rupees for this particular bond. So that is what we call as zero coupon or deep discount bonds. As the name suggests, they do not carry any rate of interest. Okay, such bonds are generally issued at a very steep discount over its face value and are redeemed on maturity. Redeem means given back to you on maturity. Now we have one such example here. If your parents had invested, okay, if your parents had invested 5,300 rupees in a bond issued by IDBI, if they have issued, if they had invested 5,300 rupees in a 1996 in a company called IDBI, which had issued zero coupon bonds or deep discount bonds, you would have got up, you would have ended up getting, okay, 2 lakh rupees. Imagine 1996, 2006, 2016, okay, 2021. Next year, if you had just invested 5,300 rupees, you would have ended up getting 2 lakh rupees. That is the 5 year, that is the investment horizon. So 25 years is what you have to invest. So here, if you observe, there is no rate of interest offered, but it is offered at a very steep discount. That is what I'm trying to tell you, the meaning of zero coupon bond. Any doubts in this, please?
No,
No,
sir.
Okay, next. We have something called as callable bonds and puttable bonds. Now, what happens is, just imagine I'm giving you a simple example. Imagine that I am a company, okay, or imagine that I am government of Karnataka. I have issued bonds worth 1,000 rupees, okay, we of face value 1,000 rupees. I am offering a rate of interest or coupon payment of 12%, right? I am offering a coupon rate of 12%, okay, and the maturity time is 10 years. So you all come forward and take this particular bond, but I put a condition that in these 10 years that the bond is going to be with you, if I feel that I am don't require your money now, I can call the bond, I can ask you to submit your bond anytime, and you have to submit the bond, and I will give you whatever is the money that is applicable. So if bonds carry such an option, we call them as callable bonds. Callable bonds means the borrower who has issued the bonds has the right to call back the bonds. So I'll call the bonds back to you. If you submit the bonds within that particular time, you will get the money that is that I'm offering. On the other hand, if you do not submit your bond in time, the bond is invalid or it has no value. Why? Because I have the option to call back the bond anytime in these 10 years. Are you able to understand? Suppose in this particular class of 20 people, 10 people decide to submit their bonds or surrender their bonds to me and take the money, whatever that I'm offering. But there are 10 people more who decide that I'm not going to submit the bonds. Let's see what happens. In such case, if you really want to see what happens, the bond will go invalid. That means you will neither get your money back nor you will get your interest back, because I had given you an option to submit the bond to me. If you do not submit it, that means you are not accepting my offer. And if there is no acceptance of offer, naturally the contract becomes null and void. Clear? So this is what we call as callable bonds. If borrower has the right to call back the bonds, is called callable bonds. Then what are puttable bonds? Puttable bonds are those bonds wherein you want to sell the bond to me. I have not called back the bonds. I don't want you to come and submit the bonds and take the money. But if the bond carries an option, and the option says that in these 10 years, if you, that means lenders, want your money back, you have to exercise a puttable option or a puttable bond. In that particular case, you can come, submit the bond to me, and take your money and go back. That is what we call as callable and puttable bonds. Any doubts in understanding this particular concept?
Yes, sir.
Any doubts, please?
So in callable bonds, sir,
Yeah.
they will in at what rate they will give that the bonds with the same rate or the current rate, sir?
No, what happens is, I'll give you an example. Let us say the bond carries a callable
Yes, sir.
option, and I decide to call back after 5 years. Life of the bond is 10 years. After 5 years, I decide to call the bond back, right? So what I'm going to do,
Yes, sir.
for the first 4 years, you have already taken the interest,
Yes, sir.
right? So I will discount that particular value and I will
Yes, sir.
arrive at a value suitable such that it will not be a loss to me, neither it will be a loss to you. It will be a win-win situation for both of us. I will arrive a value on that. So you cannot say
Okay, sir.
you cannot say that give me 1,000 rupees per bond. I said I cannot give you. The reason is I have already paid interest to you for 4 years. You have enjoyed that particular interest. How can I give you 1,000 rupees? I have to give you less than 1,000 rupees. But how much? If
Yes, sir.
I'm giving you less than 1,000 rupees, then how much? So that is where negotiations take place, or that is where they arrive at the value. Yeah, Narayan.
Sir, it will be issued as callable bond only, or in the beginning it will be issued as straight bond or zero coupon bond, and
No,
then
no.
they call
Generally,
back.
what happens is if you purchase this particular bond, it will have an option whether it is a callable or whether it is a puttable. If you tick if you tick on callable, that means you are giving the option to the company to call the bond back. If you don't tick that option, that means you are not giving that option to the company to call the bond back. Today, generally,
Okay, sir.
all bonds that are issued are issued with non callable option, because it creates a lot of problem for the investor, and it also creates a lot of problem for the borrower also. So they have, over a period of time, they have started reducing the callability and the putability option in a bond, because it is very tedious to calculate. You have to discount the value, you have to arrive at, you have to find out present value of all the interest that you have, that has been paid. So it's a very complicated procedure. That is the reason they generally tend to avoid callable bonds and puttable bonds. They always go for either straight bonds, that is the reason it is the most popular bonds, or they go for deep discount bonds. Anything else, Narayan?
No, sir. No, sir.
Next, we come to a concept called as floating rate bond. I'll just finish up with this particular slide. In case of a floating rate bond, as the name suggests, the rate of interest is not fixed. The rate of interest keeps on changing. Okay, and depending on whatever is the present PLR, that is prime lending rate, the rate of interest keeps on changing. That is what we call as floating rate of interest. The example is available here. In 1993, State Bank of India came up with the first floating rate bond issue. Okay, the coupon rate offered was 3% above the maximum term deposit rate. Now it's very simple. What this particular offer says, it says that um, what is the rate of interest on fixed deposits? Let us say 8%. For 5 years, if you keep money with in terms of fixed deposit in a bank, what is the rate of interest that the bank can give you? Let us say 8%. Okay, so the deposit rate is going to be 8%. So what did State Bank of India do? Whatever is the highest possible deposit rate, on that we'll add up 3% more and we will issue a bond. That means if deposit rate is 8%, 8% plus 3% is how much? 11%. So State Bank of India said we will offer bonds at 11% rate of interest. Now if tomorrow, if the rate of interest on fixed deposit changes from 8%, if it goes to 7%, then what will be the floating rate of bond? It will become 7% plus 3, that will become 10%. This 3 is not going to change. This 3 will remain constant. But what is going to change? The deposit rate, if it changes, proportionately your floating rate also will change. Are you able to understand what I'm talking about? Any doubts in this, please?
No, sir.
Sure? Okay, Rashmi, tell me.
Rate will be fixed.
3% will be fixed. This is a markup. What is going to
Okay, sir.
change? Your
Okay.
deposit rate is going to change. Nabiraj, tell me,
Okay.
if the deposit rate is say 11%, if the deposit
Okay.
rate is 11%, what will be my floating rate of on the bond?
14%, sir. 14%.
Yes, it will be 14, because 11% is deposit rate. 11 plus 3, okay, becomes 14% rate of interest. Are you able to understand?
Yes, sir.
Conversely,
Yes, sir. Yes, sir.
if the deposit rate reduces, if the deposit rate becomes only 6%, okay, what will be the floating rate? So
So
6%
plus
plus
3,
3,
9.
9% will be the
9.
floating rate. Getting it? So this
Yeah.
is what we
Yes, sir.
call
Yes,
as
sir.
the floating rate. So this was done for the first time by State Bank of India in 1993. Okay. Next we have something called as commodity bonds. Now here, if you look at it, okay, just let us see the example first. There was a company called as Standard Oils. Okay, in 1986, they issued a zero coupon commodity linked bond with maturity in 1992. Look at the time frame, 1986 to 1992. So 6 years is the time maturity of this particular bond. In these 6 years, what they told is, we are not going to offer you any rate of interest. Okay, it is going to be a zero coupon bond. No rate of interest will be applicable on this particular bond, but this bond is linked to a particular commodity. And what is the commodity? The commodity is oil. So on in 1992, on the date of maturity, whatever is the price of oil, whatever might be the price of crude oil, on that we will give you a markup of $200. So if the oil price on that particular day is $88 per barrel, so $88 plus 200, so 288 rupees is your maturity value. On the other hand, if the price of one barrel of oil on that particular day in 1992 was 130 rupees per barrel, that means 130 plus $200. So total maturity value would be 330 rupees. Are you able to understand this? Your maturity value is linked to a particular commodity, and that commodity is oil. Are you getting it? Yeah. If you have any doubts, please tell me. Do you have any doubts here in understanding what do you mean by floating rate bond and commodity bond?
No, sir.
Okay. In fact, in India, there was a company called as IOC, Indian Oil Corporation. Okay, that company also issued commodity bonds when it wanted to start its Mathura refinery. That time they also issued commodity bonds, and the condition was, after the refinery comes into existence, once it starts functioning, whatever is the price of crude oil internationally, on that we will give you a fixed percentage or a fixed amount of money. That is what we call as commodity bonds. So here the percentage is fixed, the money is fixed, but what is depending on, it is depending on the that particular commodity, and the commodity in our case is oil. Yeah. So these are called as commodity bonds. The last one we have is convertible bonds. Convertible bonds are those bonds which can be easily converted into equity shares. Clear? Converted bonds are those bonds which can be converted into equity shares. So these are a type of bonds. Generally, nobody goes for convertible bonds because it's risky. Uh, but there were companies some time ago who had issued convertible bonds. One such example is Reliance Industries Limited. Way back in 1986-87, they had decided to come up with convertible bonds. Okay, triple converted bonds. That is what the name was. So, by the way, I want to tell you one thing. On Sony Max, I don't know which channel, there's a web series that is coming. Okay, the name of that web series is The Scam. Have you come across this?
So it's Sony only.
It's on Sony, right? Okay, okay.
Sony Live.
Sony lives, sir.
92, sir.
Okay, okay. The Scam.
Already finished it, sir.
Okay. So please watch that. It's a very good, it will give you a deep insight as to what happened during that particular time, how Harshad Mehta created this particular fraud. Everything is available for you. Please watch that particular series. It's a fantastic series. Okay. And if you really want to understand how companies played with this particular convertible bonds to equity shares and converted equity shares back into converted bonds, please watch the film Guru, Abhishek Bachchan and Aishwarya Rai. Please watch that particular movie, because in the last couple of scene, he clearly says what is his intention. Okay, so we'll stop this class here. In my next class, I'll continue from this particular slide. I will be taking next class as tax management. I will tell you the time accordingly. Okay, we have less than a minute. I'm stopping it. I just want to take the attendance.